Hi, ladies and gentlemen. Today we're going to be talking about stocks and bonds. So stocks and bonds are two very common investment vehicles that people use in order to invest their money for the future. And we talked earlier in the year about Warren Buffett, a very famous stock market investor, very famous bond investor, made billions of dollars using economic principles in the stock market. And so today we're going to be focusing in on and comparing and contrasting stocks and bonds. So let's start off by talking about stocks. So stock is a share of ownership in a corporation. When you own a company's stock, that basically means that you are partial owner of the company. So if the company does well, you earn money. If the company doesn't do well, you lose money. So owners of stock make money in two ways. First, they receive regular dividends from the company. So a dividend is basically a kind of a thank you payment from the company for owning their stock. You can also sell the stock at a higher price than the original purchase price. This is called a capital gain. So when you buy and sell stock, you buy per share. So if you bought the stock at a certain price per share and then sell it at a higher price, then you have a capital gain. You've made money. Now, if you buy the stock at a certain price and then sell it at a lower price, then you have a capital loss. And although that is a tax write-off, that is not a good thing. You don't make money with capital losses. So I'm going to go ahead and show you guys the kind of websites that professionals look at if they were doing some stock market trading. And the one I'm going to show you today is CNBC. There's lots of good business websites out there. And I'm going to show you how to navigate through a business website. So first of all, if you look all the way to the right, you'll see three green blocks. Those three green blocks show you the three stock market indexes. The stock market indexes show you overall how the market is doing. The one all the way to the left is the DJIA, the Dow Jones Industrial Average. This takes a look at the 30 biggest companies in America and how they're doing. Today you can see it's up about 0.78%. The S&P 500, it follows about 500 companies, and it's up about 0.4%. And the Nasdaq follows tech companies, and it's up about 0.3%. There. So lots of times stock market investors will look at these indexes to see how the overall market is doing. Now you can also see how individual companies are doing. So if you take a look to the left and we put in the ticker for Microsoft, it's just the symbol for Microsoft, MSFT. We go ahead and click on that here. And we can see overall for today and throughout the year how Microsoft is doing. The close price for today was $42.85 per share. It was up about 1%. If we look at the detailed quote there, the high for today was about $43.13 per share. Low for today was about $42.19 per share. The volume was 32.1 million shares, so that basically means 32.1 million shares changed hands, so lots of trading of this stock. The 10-day average volume is about 29.6 million. The year-long high was about $50.04. The year-long low was about $37.51. And the one-year change is about 13%, which means that if you bought Microsoft stock a year ago and you compared it to today, you would have earned about 13%, and then held that stock till today, you would be earning about 13% on your money, which is way better than putting your money in a bank account where you're going to earn about 1% on your money. Okay, so those are the kind of numbers that professional investors will look at in order to make money in the stock market. All right, so stocks are traded and sold by brokers, and brokers are just people who link buyers and sellers of stock. Lots of times they'll work for banks and so forth. And stocks are traded in stock markets around the world, the most well-known being the New York Stock Exchange, the NYSE. Generally, you might ask yourself, how do most individuals buy and sell stock? And generally, a lot of them will go through banks. They'll also go through online brokerages. So you might Google like Fidelity. You can click on Fidelity Investments here. And you can go ahead and set up an account and trade stocks and so forth through Fidelity. And there's a lot of, there's Scottrade, E-Trade, lots of good websites you can go and you can buy and sell stocks through. All right, so this is a picture of Mr. Vanderpool in front of the New York Stock Exchange. You can see I'm sporting my Angels hat there. I thought it would get picked on a little bit with an Angels hat in New York, but nobody cared. And then the inside, you can see there, of the New York Stock Exchange on Wall Street. If you have a very busy scene of stock traders and brokers buying and selling stock. All right, so what are some of the determinants of stock prices? What are some of the factors that help influence stock prices? So the first one is corporate finances. If investors are deciding whether or not they're going to buy a stock or not, they're going to take a look at the corporation's finances. So investors usually will take a look at a company's financial reports. They'll take a look at their balance sheets, their income statements. Is this company making money? Is it earning money? And that is the number one thing that stock market traders are looking for when they're evaluating whether they're going to buy a stock or not. Investor expectations. Investors will buy a stock when they expect the price to go up, and vice versa. If they expect the price to fall, they're more than likely not going to be buying the stock. And you have external forces. These are forces that private firms have little control over, like the unemployment rate, interest rates, elections, lawsuits. Some other things here that you might see on the test. The test talks about blue chip stocks. These are usually strong, well-known companies. And another little piece of advice as far as buying and selling stocks. One of my favorite pieces of advice actually comes from Warren Buffett. And Warren Buffett said, be fearful when others are greedy, and greedy when others are fearful. Okay, so what that means is when people are fearful of stocks and they're not buying stocks, then you're going to see the price of stocks low. That's when you want to go ahead and buy out the stocks. So to make money on the stock market, you have to buy low and sell high. So you buy when people are fearful, they're not buying stocks, stock prices are low, buy then, and then you can sell at a later time if you want. Okay, so be greedy when others are fearful. And you need to be fearful when others are greedy, because when others are greedy and buying up stocks, that means the price of the stock is really high. You don't want to buy it then, because then what ends up happening is the stock market falls and you have to sell at a lower price. So you want to buy low, sell high. That's how you make money with stocks, and that's really how you make money with almost any asset there. All right, so a little picture here of Mr. Vanderpool again on Wall Street. There's a couple of things that are on Wall Street. You have the actual New York Stock Exchange. You also have this famous bowl that Mr. Vanderpool is standing next to here. The bowl symbolizes a bull market, and a bull market is basically a market that is going up. Well, people on Wall Street like that, so they have a statue erected to it there. All right, and the reason that the bull represents the bull market and represents a market that is going up is because when bulls attack, they swipe their heads up. So therefore, when a stock market is going up, it is a bull market. This is the opposite of a bear market. When bears strike, they strike down. And so therefore, a market that is going down is called a bear market. No statues of that, though, because people on Wall Street don't like that as much. All right, so let's take a look at bonds. So we've talked about stocks, where you're buying a share of ownership in the company. Now we're going to talk about bonds. And bonds are when you are buying the debt of a company or a government. So when governments and companies, they spend more than they earn, they usually need to issue debt in order to pay their bills. And you can buy that debt for a return, and when you do that, you buy a bond. So bonds are generally a safer form of investment than stocks, because if a company goes bankrupt, the bondholders will get paid off before the stockholders. Because what happens when you have a bankruptcy is the business will sell off all their assets and they'll have to pay off their creditors. So they'll pay off the bondholders first before they pay off the stockholders. So therefore, the bonds are a safer form of investment than stocks. Investors will buy them because they'll get yields. They'll get interest on money owed to the bondholder. Okay, so you don't. You could either buy a bond and hold it and earn interest for a specific amount of time, and bonds will last for specific amounts of time, 1 to 30 years, whatever it might be. And then you're earning interest that entire time. You're getting those yields. You can also buy and sell those bonds in order to earn a profit. So when you buy a bond, you're not only going to get your principal back, which is the original amount that you invested, but you're also going to get those yields. Now there are two major types of bonds. First one is a corporate bond, which is basically you're loaning money to a corporation. You're buying a corporation's debt. Then you have government bonds, where you're loaning money to the U.S. government, where you're buying the U.S. government's debt. So that would be U.S. Treasury bonds, state and local bonds. Those state and local bonds have lots of tax advantages, so lots of people like those. Now, the U.S. Treasury bonds can be broken up into bills that have a maturity of a few months to a year, meaning that you're going to get your money back that you loaned out from a few months to a year. You have the Treasury note, which is about 1 to 10 years, and bonds are usually about 30 years or so. Okay. So let's go ahead and answer some questions here. So when a stockholder sells a stock for a higher price than they bought it, what have they made? And then for 2, determinants of stock prices include what? So I'll give you a few seconds for that. And you can pause it if you'd like. And then you have the summary. We've compared and contrasted stocks and bonds a lot today. I want you to go ahead and tell me some differences and similarities between stocks and bonds. All right, folks, so thank you very much. I'll let you go ahead and finish up that summary, and we will go from there. Thank you so much, and have a great day. Bye-bye.